to the Avondale webinar on buying and selling companies and best exit practices. I'm Kevin Uphill. I'm the chairman of Avondale Group. I've been helping people buy and sell companies for 20 years and completed over 300 transactions. We have a team of about 25 people selling companies UK and internationally, and we do about 30 deals a year. Specialists in the mid-tier and quality SME end with a transaction range of about 1 to 30 million. Tonight we're going to be covering what's happening in the marketplace, valuations, how companies are valued, shareholder value, some tips and ideas on how to increase value, and actually the process that we go through in terms of creating best exit value and getting top dollar on the sale of a business. As it's a webinar, can I remind you, it's really helpful if you give us some questions as we go along. The chat box is on the right hand side, so please fire away as you go along. We can then hopefully cover some of those elements. So please get some questions in. It makes it better, it makes it more interactive. So really the first point is what's happening in the marketplace and why are people buying and selling companies. This slide shows you what's happening in the emerging and developing economies after the recession. So you can see that big dip down, which was 2008-2009. Actually, if you look at that, we're still not really seeing much growth beyond where we were in 2007. So what that tells you, although the economy has recovered, the recovery is very, very slow. And all the economists that we know are talking about a 2%, 1% growth going forward. Why is that? Basically because we have an aging population in the UK, the balance of power is shifting more towards the east and those emerging economies, and also we have a big balance sheet deficit, which is where we're seeing that austerity measures and the revenue really pushing hard to generate as much cash out of the economy as possible. Why is that relevant for mergers and acquisitions? Basically, it means that we're very, very busy and we're getting more and more transactions coming across the desk. Fundamentally, it's because organic growth is slow. If you think about it, when organic growth is fast, management teams, executives focusing on that organic growth and they're looking at creating shareholder value for organic growth. If organic growth is slow, then you're forced to look at deals to create shareholder value. So fundamentally, it's a good market driving deals. And that's the backdrop that we're seeing. Who are we acting for? What are the motivations? Well, most of our sellers, the old-fashioned method of changing hands was family succession or a management buyout, for example. But increasingly, we're seeing that those trends reduce, mainly because the companies that we're dealing with are too expensive, but also often because family succession, sons and daughters want to go and make their own path. They're not as interested in running those businesses and taking them on for the second generation. So if all these people are selling, who are we seeing buying companies? And I've mentioned this before, effectively it's the guys looking for shareholder value. What we describe it as is the 1 + 1 + 1 = 6 equation. Buyers, the first one is they're looking for economies of scale. The second one is the synergy, the ability to cross-sell. So perhaps, for example, you're an IT box shifting company and you're looking to buy a managed services business. Certainly that was a deal we did last year. The third one is if you can buy at a multiple of 5 or 6, but you yourselves are trading at a multiple of 8, or putting the two together, you get the economies of scale or synergy, then can you sell at a multiple of 10? It's a shareholder value play. And the best deals have all three of those elements in component. And that's why people are looking really hard at acquisition. And we're getting on average 3 to 4 offers per project that we're working on at the moment, which is very good news for sellers. So the first step that we need to look at if we are potential sellers is really, what are the likely values? Of course, there's a process, there's a competitive environment, all of those things influence value, and ultimately it's only on a day of completion you know what the value is. But for strategic planning purposes, it's useful to get what we call an accounting valuation as a foundation. We then go out and try and beat that through the process that we employ. So this slide shows you some of the sort of valuation methods that are used. Discounted cash flow is rarely used, so I'm not going to cover that. The main method is what's known as a price earnings multiple of profits. And that's usually done on a pre-tax basis, and it's normally debt-free, cash-free. So most of the deals that are done in the marketplace are on a share transfer basis. They include the limited company, they include the balance sheet. What you don't want to be doing is including in your value surplus cash. So debt-free, cash-free gives you a way of working out what is the surplus cash. Debt is not trade debt. It's things like HP, directors' loans, finance, and HMRC, but it's not the trade debt. Cash, of course, is cash. And what you're looking for with a financial valuation is to look at the foundation. And normally a competitive environment will significantly beat the financial forecast. Let's have a look at how that translates in terms of real valuation methods. So problem there with the slides, just for a second. So this slide shows you what we think price earnings ratios might be in the marketplace. The dark brown in the middle band is the accounting valuation. The gold along the top and the grey is the strategic valuation, and that's where the majority of our deals are. You've got multiple in year's earnings down on the left, and across the top band we've got adjusted profit in thousands. Now we need to look at what we mean by adjusted in a minute, but you've got EBITDA, earnings before interest, tax, depreciation and amortization. That's relevant for service companies where depreciation is an add back. You've also got PBIT, and that is profit before interest and tax. That's more appropriate for high capex businesses like manufacturing. So you can see that the bigger the profits, the bigger the multiple. That's the first really important point. And that's why, again, people are really interested in buying companies for shareholder value. If you put 2 or 3 smaller companies together on a buy and build strategy, put them together, get those economies, get those synergies, then you push your own value up beyond the price paid. The second interesting thing is, say, the bigger the price, the bigger the profits, the bigger the price. The second interesting effect on why that occurs is normally the bigger the profits, the less dependent on the owner-manager of the business is, or the management team of the business is, the more sustainable the cash flow of the business. Not always, but normally. And also, potentially, the higher the economies of scale. So at the moment we're negotiating on one which has got a profit of a couple of £1 million, and the multiple is actually 13. Why? We've got 180 people in the business. The buyer, we think, will save about 40 of those from a headcount perspective. It's still a strategic deal, but they will get significant economies of scale on the transaction. So that enables the multiple to push up off the scale. So the multiple is the number of years earnings times the profit. The bigger the profits, the bigger the multiple. The other big impact on that is this sustainability. So increasingly we're finding deals being done on what's happening now and the forecasts, as opposed to the last 3 years average profits, which is the more traditional method that accountants tended to use when looking at valuations. It makes sense. The forecast profit is where the revenue is going to be generated. Last year's profits have already been spent. Let's have a look at it live. So here's a deal we did last year. This was a medical clinic. The debt-free, cash-free adjustment was pretty negligible. So the shares were being included in the deal, but there wasn't a lot of adjustment on a debt-free, cash-free basis. They had taken a fair bit of money out of the business over the years, so there wasn't a lot of surplus cash. It is a good tip pre-sale to leave as much money into the company as possible. We don't want it included in the valuation, but if you can include surplus cash, you get your 10% entrepreneur's relief on it. So a little trick many sellers look at is 6 to 9 months before the deal, stop taking money, build up the cash reserves, get it added to the deal value, get your entrepreneur's relief at 10%. On this medical clinic, wasn't much of an adjustment to the balance sheet. There were, however, some adjustments to the profit. We had this was a fertility clinic, went to a private equity-backed company, and we had profits of 438,000, bought by Care Fertility. The adjustments, they weren't charging enough rent, and that was for historical reasons, and also they hadn't they had a manager. We were able to argue that they didn't need that manager, so we adjusted those. But the other thing is they weren't taking enough salary themselves, so we had to put that back in to create an adjusted EBIT. We didn't do an EBITDA because depreciation is a real cost. Medical equipment is expensive. So we said to them, medical, good recurring revenue on a measured basis, financial valuation, we think probably around 5.5 times multiple. Going back to that previous slide, so 2.86 million. We actually got 4 million. We had 2 bids, and part of that was in the competitive environment because we played the parties off each other to get that top price. This is a rare asset. There's not many independents available. The market is consolidating, so we used that to drive the price. But the other part was we used the forecasts. Now we could see, and we were able to present very strong forecasts, that we could actually get to an adjusted EBIT of around 750,000. If you actually come back also to the deal on 4 million with an operating profit of 438k historically, the actual multiple is 10. So it's really critical. When people talk about multiples, is it a multiple of historic profit? In this case, we actually got a multiple of 10 when we did the deal. How did we do it? We used forecasts, but we also had a good deal structure. So we got 2 million on completion. Cost of financing transactions is expensive. This was private equity backed by Beaumont. They didn't want to have a significant cost of capital in terms of debt, so we agreed a deferred payment. We felt the covenant was strong. That was dependent on the doctor staying, so it had some sort of lock-in. So the guaranteed money was around the £3 million mark. But the other area was we got £1 million earnout dependent on us achieving this 750k EBIT that we forecast. And that's how we got that £4 million headline deal value on that transaction. So there's some other transactions that we've been involved in and seen, and really quite useful. I won't run through them all in depth, but you can see price earnings multiples vary, 7 to 14.2. We got lots of awards for the meter provider deal, although we've listed that as a multiple of 6. Those profits at 3.6 were actually the forecasts. Again, historic profits were more like 2, so in reality the price earnings multiple was 10, and it just depends how you want to express it in terms of transaction value. Particularly like the updated deal there, the chap who sold that went to Capita. He had taken private equity in 3 years beforehand, and very, very, very strong recurring revenue. They did fibre optics, broadband technology for local authorities. It was all contracted revenue. Again, contracted revenue gets you much, much higher multiples. Right now, for example, we're doing some acquisition work in the lettings sector. Those multiples are very strong. But when we value the estate agency part, you get low multiples because you're only as good as your sales team. You're only as good as your current portfolio in terms of your instruction mandates. So contracted recurring revenue is critical. Updata says great deal, very, very strong multiple. What's fascinating also about that deal, the guy selling it, the key guy selling it, is now in Devon. He's running a manor house down there and holiday cottages. He happened to also go to the same school as me, and he was phoned up by the business development director there to help raise some funds for a trust that they've got. And this guy spoke to him for 5-10 minutes and said to Jamie, are you interested in contributing? I hear you've got a large sum of money. He politely heard him out before gently pointing out that he had been expelled, which I rather enjoy. The point of that, of course, is it's entrepreneurs that make the real wealth, and it's people who don't think in straight lines that make the real wealth. So I'm sure we can all see some of the metrics for driving value, and we're very happy if you're thinking about evaluation is to send in accounts. We will only ever give a forecast financial value. The process is designed to create a competitive environment and therefore beat those forecasts, and that's something I'll talk to you about later. But let's just assume for a second that you are unhappy with the value and that you want to work on enhancing the value, and this next section is going to cover that. So how do we increase shareholder value? Well, we've talked about buyers doing acquisitions, so of course that's a top area to look at, acquisitions, but there's lots of other little things to look at when you're looking to prepare for sale. We have a service called Value Builder, and we describe that in two ways really. First element of Value Builder is what we call house doctoring. So that's the 6 to 9 months out, the small elements of tidying up. I haven't put them here, but what you're looking for is stuff like, have your contracts got change of control clauses? That can often cause significant problems. Is there a minority shareholder where you need to look at a company buyback to ensure that all the shareholders are fully aligned? Is there a freehold on a property? Will the buyer want the freehold? Do we need to merge it out or hive it off? But other areas, for example, the sales and marketing process and the website, very often we help people looking at how to position the business more effectively in those areas. And we've got two Value Builder clients where we're helping facilitate the sales and marketing and website rebuild. The key behind that is if we can show in the pipeline that we've got strong forecast revenue and strong new orders, then that will be taken account in the valuation. Another area, we spend a lot of time putting together data packs for people. We now, when we launch a project, do a virtual data room. And when we do that, we do a form of reverse due diligence. So that is looking in depth at the business as if we were a buyer. And it's that corporate, legal, commercial, financial and customer due diligence to make sure there are no pitfalls and that we thought about all the different elements. And finally, within that area, I would say making sure you've got the right reporting and the right systems. I've mentioned before that buyers are looking very, very much at the forecast, so we need to be able to show the recurring revenue behind the business and link it to those forward forecasts. So if you can't get accounts in real time showing that information, then that causes an issue. Quite often we put together what we call a client recurring revenue schedule. You know, the old days when you put together this year's debtor list and creditor list and bought a business off that just doesn't work. Who have been the top 50 clients for the last 5 years and what is their repeat buying pattern and likely buying pattern? That is critical. So we call that house doctoring. The other element of preparing a company for sale is where we look at property development, and that's really where somebody comes to us and says, I've got a business, I'm worth 3 million, we want to be worth 9, how do we get there? And really I think this slide is starting to hint at some of the key areas that are designed to work for getting there. We've done all sorts of things for some of our clients. One client was a lettings agency, had 3 branches, we closed 2, centralised it, reduced the cost base dramatically, enhancing the profits and therefore doubled the value of the business. Another client at the moment we're looking at, their gross margin is weak, so we're looking at how we can justify looking at a new pricing structure. But fundamentally, getting a value for a business on a long-term basis is about creating competitive market advantage. It's about creating a brand and reputation with barriers to entry where the buyers are sitting there going, we want, we need that. And actually they're fearful that if they don't buy you, somebody else will. It's also about creating what we call breakthrough plans. Let's have a look at this in a little bit more depth. So the key for us is working with the owners around looking at their business design and creating that breakthrough plan. Business design, how much time do you actually spend on looking at your recurring revenue streams and your repeat customers? And also looking at where your market is going, and that for me is the most critical. It's about taking a longer curve out and understanding the market drivers behind your business. A classic, for example, I know you think you're good, but actually, when was the last time that you really looked at your competitors' websites? Not just a day, but for 2 weeks, for 3 weeks. What is their positioning? What is their true competitive advantage? And what are you doing that is better? And that takes time and research. So the most important value builder tip we can give is around moving from management to leadership. The idea there is that quite simply too many business owners, even the corporate owners, are too hands-on in management. Their meetings are far too much about, is Fred any good at his job, which is management, rather than where is our market going? How do we create a niche with good recurring revenue ahead of where that market is going? And that is taking time out from a strategic perspective. The benefit to that is, of course, it makes the business less dependent on the owner. So you're not only doing two things here with value influencing. You're increasing the multiple because you make it less dependent by moving into leadership. But the other element is, again, this recurring revenue stream. And it takes time to design. What new products, territories, strategic alliances, acquisitions and research do you need to do, understanding where the market is potentially going to place the business in a we want, we need motivation from a buy-side perspective. That's about branding, it's about positioning, and it's about looking for the niche that you can own. And the biggest area that we work with is around the time of the leader's role. We often do a time audit with people, and it's quite fascinating how little time people actually spend on research and strategy and how much time they're dragged into management. I'm asked quite regularly why that is, and actually I've got my own personal experience of this. I think fundamentally it's because most people who run companies like to feel important. They also don't feel when they're working in strategy that it feels like work, and it makes them feel uncomfortable. And they don't have a conversation with their team that gives them permission to go and look in those additional areas, and they don't spend enough time from a training perspective developing the second tier management to grow and drive the business for them. And understandably, the principals, the real key is that they don't work in a silo. They see the whole picture. So they understand the marketing, they understand the finance side of it, they understand the product, they understand the strategy. If you look at the second tier, very often you have a finance director who doesn't really understand what marketing do, or a marketing director who doesn't understand what finance do, sales guy who doesn't understand anything. And actually the real key to getting a team-driven business is getting that second tier looking more at the big picture and understanding each other's roles to join up the day-to-day management of the business. That enables you to go hands-off and focus on the new products, territories, strategic alliances and acquisitions, and that's where you get your sort of triple, quadruple multiplier in terms of deal value. Ultimately, higher multiples because you have a team-driven business, but also a market-driven business. By market-driven, what I mean by that is you're in demand, not the other way around. The market is looking at you and saying, actually, we really want to use you because you're doing something different that we can't get anywhere else, rather than you having to persuade them all the time that you're the best. So that is what we call top-line property development value builder. Design the business, look at the leader's role, get the business more team-driven, then work in those new products, territories, strategic alliances, acquisitions. Ultimately, designing a business that is more team and market-driven ahead of the competitors. So assuming that you've already done your value builder work, and as I say, we work 4 years out with people, we do strategy sessions, we work 6 months out doing that house doctoring, that pre-sale grooming with people. I think we're quite unusual as an M&A house with that strategic ability. And one of the reasons why the IOD used us as a preferred house from a corporate finance perspective. But the other area that is really critical to you guys is, well, what is the actual M&A process and how do we make sure that it's run correctly so that we get the maximum price with the least disruption to our businesses? So I'd really like to talk about that before we then have some questions towards the end. So, selling, if you can get an auction going, you can increase the value by 200% or more. And this process that we have here is designed by us in order to try and create that auction process. And we achieve it on the majority of our projects. We get away around 80% of the projects. We don't sell every single one. Sometimes businesses change, sometimes circumstances change, but we have a very, very high conversion rate. And we have a high conversion rate in that strategic deal value range. And that's absolutely critical. So how do we do that, or how can you do that? Well, we've already talked about it. Value builder is critical. When we work on an M&A project, even when we're looking at a short time frame, we will always be looking for what are those preparation tips to make sure that we have an orderly house to get through the due diligence process without any pitfalls. And that's important. But the third area really is this Datapack work that we do. So when we run a project, we'll put together a teaser. It won't say who you are. We then do an information memorandum. Now that's a crafted document, and it talks about the forecasts, and it's really important that it talks about that breakthrough plan that I mentioned earlier. Can you imagine going to market saying, we're tired, we've run out of steam, and we don't quite know what to do with the business? It's not great leverage from a market perspective. It's far better to take the position of, we've really looked at what we're doing, we can see where the market's going, we know how to take this business and double it, we are going to do that, but we're not sure we are absolutely the right people to do it. So at this point we're exploring to see whether there's a strategic partner that could take the business to the next level with us, and we will consider an exit strategy as a consequence. A much better position. So the information memorandum is a much around driving those forecasts and creating that vision for the buyer. And of course we will remodel accounts to show those potential adjustments. It's subjective. We'll have a lot of debates with the buyers about what's real, what's not real, and the adjustments will be different for every buyer. But we will do that analysis and that work. The third element in a data pack, and we're unusual in doing that, we put together a virtual data room. And that's, again, around creating visibility. We don't let everybody see the IM or the virtual data room. We get a confidentiality undertaking first, and we make sure that we get all permission before we release that information to make sure it's not commercially sensitive. But the idea around the data room is it's a transaction accelerator. What you don't want is to get to a point where you've agreed a deal and then the buyer's doing their due diligence, employing clever lawyers and accountants with the sole aim of dropping your price. It's absolutely critical that the price we agree at heads of terms is the one we complete at, and the more visibility we give them up front, the less excuses they have to try and chip that price. So the data pack is really critical to maintaining top dollar. But of course the next bit that's critical is talking to the right strategic buyers. We have access to international databases, Mint, Market IQ, we look at also all the private equity community. It's around profiling and researching who's doing what deals, why, and who has the most strategic deal value from your business. Who's got the balance sheet and who is therefore likely to be the best buyer as a consequence. Typical, the bigger the project, we might only approach 30 to 40 people. We did one recently which was 15 million where we only approached 10 and we got 3 offers. So the bigger the company, the less people you might talk to. On a small project, we're doing an IT one at the moment, £1.5 million turnover, about 350k EBITDA. Off our own database, we had 35 non-disclosure agreements, and that's before we've gone out and done the profiling. So it just depends on the size of the venture, how many you might talk to. It's really important that those conversations are strategic conversations and discreet. So we do a lot of work, and again with the bigger companies in particular, making sure that it is personal, direct conversations to the managing directors and FDs, and also making sure that confidentiality is maintained throughout to protect your goodwill. If you look at this from a timeline perspective, most of our projects are between 6 and 9 months. The first 2 to 3 months is the value builder and Datapack area. Sometimes, as I say, we're working way out beyond that on value builder, but typically 2 to 3 months there. Profiling and research, 2 months, buyer side, meeting people, creating the competitive environment, data information flow, and then meeting buyers is another 4, 6, 8 weeks. We sit in on all those meetings, and it's really important that those meetings are conducted in an objective manner. Far too many sellers are all push and persuasion around why their business should be bought. And actually, like any sale, the best deals are done through a consultative sell. And it's really important to understand the buyer's motivations and make sure that we try and then fit within that strategy rather than pushing our transaction mindset down on them. So it's very important your advisor is not just an M&A guy, but he also understands strategy and also therefore the buy side mentality, so that we can actually listen and hear what their buying signals are to create the best price. We market and we recommend that from an exit point of view that businesses are marketed on an offers point of view. That enables the market to decide the value. And then we've got this equation also of debt-free, cash-free, as we mentioned earlier. So offers again allows for, if the business is building up working capital, some flexibility in the deal value as you move forward. Ideally, if you've done your research correctly, or an M&A house like us has done the research correctly, we will get 3 to 4 offers from a competitive environment. It's then playing the bids off each other, but it's not just at transaction creations phase 6, it's not just about price, it's also about deal structure, business plan, and for you also culture. Are they going to want me to stay? Have I got to help? Is there an earnout? Why do I trust these people to run an earnout? How do I protect myself in that kind of scenario? Are these the best people to look after my team? I'm very loyal to my team, so that's all the cultural side of it as well. I'm not keen to have an earnout. I want to maximize top dollar in cash. Fine, that can work. But also increasingly we're finding elevator deals and earnout deals, if you get the right sums of money up front, still beating that financial valuation in terms of a strategic deal, but you can get earnouts or elevator deals where then working with the buyers you get a second bite of the cherry in taking an additional deal value. So all of those elements get looked at. Ideally, obviously all cash on completion, but there are other ways to maximize the price as we looked at earlier. So a good lead advisor will be working with you from start to finish, whether it's value builder or Datapack, or understanding the strategy of the buyer to that negotiation, which is not just about the deal value, it's the business plan, the culture, and the deal structure. Typically 4 to 5 offers, and then you are playing the parties off. You will have to give exclusivity at some point. Now, we're making sure we vetted people throughout, so we have a very high conversion rate at that point in terms of sale to completion. But if you've got your data room right, you are more likely to get the deal across the line. But there is a project management job. We've got to get this through the lawyers. We've also got to get this through the finance committee. Quite regularly, corporates will have a committee, or they'll be relying on bank funding, and we've got to make sure that that is all lined up. So again, lead advisory, not just about introducing the best strategic buyers with a competitive environment, it's about making sure the project management happens in a way that minimizes your distraction and maximizes the deal value to make sure it happens. I suppose the final point for us, therefore, is that we're very often sitting in on those completion meetings, driving the deal to the end. So a couple of deals that we've done. I mentioned earlier, meter provider. This had the £2 million EBIT, but we had forecasts of 3.6, so the deal value went at 20 million. So really a 10 times multiple. And this was just a wholesale business at the end, but what we were able to do was make it look as though it was embedded in the supply chain, which they needed to do some work to create that positioning, that they were starting to create that position, so that the buyers were looking at it and saying, actually, this business has got more than just a distribution. It's starting to be a service business, and that's why the multiple was so strong for the distribution sector. And it's obviously it helps that smart meters, gas utility meters, is very much flavour of the month at the moment. We won some awards for this one as well. Why do I mention it? Because actually this is a really good example of a lateral thinking from the point of view of finding the right buyers. So this was a £3 million deal. It had no profits at the time we did a deal. It was very, very low profit, but they really were running themselves along the lines of being almost a not-for-profit charity, although it was a commercial business. The trade buyers that we talked to were struggling to see how they could turn that culturally into a profit, and so their valuations were about half what we actually achieved. The £3 million was a strategic deal because we went out to housing associations and we actually had 3 bids from housing associations. So these guys are providers of learning disability. Part of that requires having learning disability homes. Part of that requires having housing stock, and the housing associations had that. But the other reason that housing associations were really interested is it mirrored the trust basis that they were set up around making a difference in communities. So it was quasi-commercial, their trust board setups actually matched the ethos that Delos had in the marketplace. So we won quite a few awards for that deal in terms of thinking outside the box of who the likely buyers were going to be. So I'm mindful of time, and I'm mindful in terms of questions as well. So really just to sort of sum up the thinking today, we talked earlier about what's happening in the market. Mergers and acquisitions, very, very, very strong at the moment, and we see that continuing for the next 5 to 10 years. Capital is cheap, we've got low interest rates, we're going to see slow growth. We've got drag from an aging economy point of view, but also that balance sheet deficit. That's going to create slow organic growth. That forces people to look at acquisitions. Valuations, multiples ranging from 5 to 15 typically for private companies, and an awful lot of that being dependent on how strong your recurring revenues are, what barriers to entry you have in terms of the marketplace, making sure the business is not dependent on the principal owners and is more team driven, and placing yourself ahead of the market demand rather than following it. And then finally we looked at the process. How do you manage the process to maximize the price? And for us, this sort of summary slide is strategy, preparation and timing. It's taking a longer curve out of it and thinking further ahead. But we also, of course, contend it's the right team. So we've got to put ourselves forward from that perspective. A lot of awards for our work and the Institute Director's lead provider. But actually, if you're choosing an advisor, let's be objective about this. It's critical that advisor understands your ambitions. They're people that you can relate to in terms of they understand the business structure and they've got some good track record in the business structure. They're not just telling you what you want to hear. They are taking an advisory position, so they'll get strategic deal value, but they won't just agree with your overall aspirations. They will be more measured about how they get there through that preparation and that competitive environment rather than just wishful thinking. So it is about preparation, and it's about taking the time to find those right strategic deals. So if you like, and forgive the analogy, but I've likened buying and selling companies to a game previously. It's a very, very high-stake games. But the more you have the right coaches, the more you'll understand the rules, and therefore, and to be very un-British in my summing up, the more likely you are to win in this game. I'd now like to take some questions.
Okay. Ideally, what contract lengths should one look to have in place prior to sale?
That's a great question. Okay, well, typically, and you've got to look for those change of control clauses, because that's a really important point, because you know, if you've got 100 contracts, it's not so much of an issue. But if you've only got 3 contracts, then everyone's going to be looking at, can we hand it over to buy side, and does it give the customer too much leverage to review the contract? Ideally, of course, if you've got 5 or 10 years, updated with 5 to 10 years plus, that's the perfect position. But increasingly, that's more difficult. You know, if you look at, for example, we did a photocopier business and a copier business earlier in the year, 7-8 million, I think that was deal value. Increasingly, the copier space is under pressure to move from their classic 3-4 year rolling contract into 1 year only. So yeah, as long as possible, but without change of control clauses, and but aware that customers don't really like long contracts.
Here we go. In some of the deals shown, you had earnouts. It's in the buyer's interest to minimise this. So do earnouts work?
In the buyer's interest to minimise paying it out? Yeah, that's a great question as well. There's a lot of people in the marketplace that say no, they don't, and they're very jaundiced about it. And I hear that, and we've done an awful lot of work making sure that that isn't the case with the transactions we do. We believe earnouts and elevator deals are a way of getting the icing on the cake, for want of a better word. So you get your core deal value, but we use the earnout to take it way beyond that. How do you do it in a protected way? Competitive environment, make sure you have the right buyer. An earnout with a good strategic buyer with a strong covenant is far better than, for example, a financial team that's just been pulled together to do a deal. But the second thing is, it's about ring fencing the business in a way that we can track that earnout. And for me, also, that's about making sure that when you talk about tracking it, you have access to the records, and it's simple. Way too often do we see earnouts coming in on a profit-related basis. How on earth do you define profit? Who controls profit? That's a massive wrestle. I much prefer gross profit or turnover, and really for the majority duration where we are in control and driving the majority decisions. And if you get those positions right, with security in terms of perhaps a debenture on the company, if you can get it, then you will normally get your money. So it's about taking longer to think about the deal structure and negotiating earnouts that work, and you usually can do that if you've got a competitive environment. So honest answer, very rarely do we find that they go wrong, and usually we actually do get the uplift that's forecast.
Another one, how do you vet potential buyers?
That's a great question as well. Well, obviously, if it's a corporate, then you've got all your company resources. It gets harder when you start talking about high net worth individuals, and they really don't like. It's a bit like the dinner party question: how much do you earn? You know, asking someone what's your net wealth is considered incredibly rude. Having said that, we will do it. And actually, with a competitive environment, if people won't give us the assets and liability statement, show us the bank statements, give us the accountant's reference, we won't talk to them. And so it really is about, you know, being gentle with buyers, but actually reminding them that if they want to be taken seriously, they have to prove their funding position. You know, everybody's very busy. We do not want to be meeting people that haven't thought it through and aren't in a position to move ahead. So just about taking a bit longer to ask the question.
How far in advance should I start planning my exit?
When you start the business is the classic answer given by most private equity companies, and I absolutely agree with that. But you know, I think shareholder value is really part of running a business day to day. I mentioned earlier that bit about strategy versus management. How much time is spent on managing the multiple in those board meetings? Do you know what the likely multiple is, and do you know what your multiple influences are? It's a key part of business strategy from the start. You know, we all wake up tomorrow and say, how can we earn more cash in the next 6 months? But actually, strategic value builder some of those initiatives may be 18 months down the line. You know, if you look again, I use the example of recurring revenue stream. Very often, recurring revenue streams can be lower margin, but they are higher value on sale. So sometimes people are focusing on the wrong products within their business for that reason. So I say it's really important that throughout you have regular board meetings that are strategy focused, and shareholder value sits very highly on that equation.
What are the typical pitfalls once an offer has been received and the bones of a deal are in place?
Well, it's typical. There's quite a few. I mean, the biggest one actually is what we call deal fatigue. So it's where, you know, the data room, and we obviously we get rid of this. That's why we have such good conversion rates. But actually, you know, we do see other deals as well. So the data room's not been put together very well. The level of information buy side want, you know, values haven't changed after the crash much. But I tell you what, buyers are a hell of a lot fussier in terms of that corporate compliance and corporate due diligence, and they tick every single box. Sellers get tired, buyers get tired asking, you don't get enough visibility on the business, everyone gets deal fatigue, it all takes too long, people simply lose the will to live, and the thing falls over. So probably that is the biggest pitfall, not being prepared in terms of information flow, not understanding the level of depth that buyers want to go through, and therefore getting that ready well in advance to accelerate the transaction rather than drag it. But, you know, I mentioned earlier, you know, change of control clauses. We've had deals where you have problems with that. We've had deals where, got one at the moment, where the major customer's just given notice. There are all sorts of pitfalls as you go along. And the job of an advisor is to be aware of those and really try and prepare to make sure that they don't cause problems later.
Hope you've got your crystal ball out for this one. Should I take advantage of Entrepreneurs Relief now?
Yeah. Well, do you know what? I mean, we found pre-election actually things started to slow up a bit. People were watching. I think people were talking to us, but they weren't necessarily agreeing things. And then after election, it's gone absolutely manic. And why is that? I think, you know, you've got a Conservative government. They've got a significant majority, so we've got a 5-year curve where they are going to balance quite carefully the need to increase tax receipts versus the need to grow the economy. And I think, you know, the Conservatives are always known for the party for business. It is a delicate balance for them, so they have to be, you know, careful with that tax receipt fundraising. So clearly, Entrepreneurs Relief is being looked at. It's been tried before. If you remember, they reduced it to only on the first million. It's now 5%. Sorry, it's now 10% for the first 10 million, so long as you own more than 5%, and really critically, you're an executive director. Seen a couple of companies recently where minority shareholders have not had an executive director role, and that will cause them problems if they've got more than 5%. We're getting the Entrepreneurs Relief. But you should get it, and we think it's going to continue. And the reason is, if you think about it, growing companies for shareholder value is all designed to get people to reinvest in their businesses for growth and to realise it from a capital perspective. So, you know, the government, I think, would be very, very foolish to hit this area too hard. And if they did hit it, it's more likely to be, well, you know, it'll either be you know, we'll drop the level to 7.5 or 5 million per shareholder. Well, if there's two of you, husband and wife, it's still a 10 million allowance. It's pretty generous. Or, you know, we'll slightly change the rate. But we don't think it's going to go. So no panic marketing from us. I don't think that's on the radar. But who knows?
Okay, we have one more general question before two quite specific ones. When is the best time to sell my business?
Right, when you've got your breakthrough plan, you're really scaring the competition, you're profitable, you haven't peaked on that cycle. Businesses tend to have glass ceilings. So a typical glass ceiling is to go to the next level, we need to bring in stronger second tier management, or we need to go international, or we need a lot more funding to push this to the next level. So when you're on the up, you haven't peaked, You can see the glass ceiling coming, but you haven't hit it. The market is well perceived for your sector. And ultimately, of course, when your aspirations are hit, for some people a £5 million deal is enough. For others, a £30 million deal is not enough. So it's really also looking at your personal motivations and aspirations. But I do have an observation of that. I've been doing this 20 years, done over 300 deals. I'm a chairman of a team of 25 that do this, so I listen a lot. Way too many owners are driven by their personal aspirations rather than what's actually right for the strategic position of the business. And I think the strategy of the business should drive the question more than the personal aspirations. We've seen too many people miss the boat because of that.
Okay. We have a very successful niche company which is primarily public funded. How would we mitigate some of the negative implications that potential buyers may have regarding income that is subject to changing government policies?
Yeah, and I mean, we've done some work, I don't know, classically, for example, in the training space, this is common, you get government funding and they're forever chopping it about. You've got to, demonstrate that fundamentally, although funding streams may change, that, it's one form of funding stream or other from the government, and you've got to be in a position to do that. The other is, unfortunately, and we had the question earlier about earnouts, you do probably need to accept in that environment that the earnout is probably the way you've got to offset that risk for buyers. Buyers, the lower the risk, the higher the cash they can pay. The higher the risk, the lower the cash they can pay. That is a problem, and probably an earnout is the best way.
What is the most favourable way to position a business for sale that has limited assets, but established contracts and a book of work and customers?
So what is the most favourable way to position a business for sale? Has limited assets, established contracts, and a book of work and customers. Well, we mentioned earlier that most deals are share transfers, so I'm assuming it's a limited company. We're not frightened by a low asset base. I don't think it has much material benefit. I think actually it's really understanding what is the cost per acquisition of a contract for you. How can we demonstrate that we are, quarter away or halfway on the journey, and if you can show that you've got a really clear model for building up those contracts on a sustainable basis, then we can start linking a deal to forecasts in terms of that growth, and that's how you get the best price. So it's always about looking towards that future, but demonstrating that it's on a thought through, obviously nothing guaranteed, considered basis that we will get that growth.
Is maximising value a service that you can provide irrespective of the business being for sale?
Yes. Yeah, I mean, we do. I don't want to sort of too self-promoting, but I've got a book out next year on Kogan, which is already on Amazon, which is Creating Competitive Advantage in Dynamic Markets, and it's a pure strategy book. So our strategy team work on, and there are three of us in the strategy team, and we're building that as we speak. We work on doing acquisition work. We work on new product development with people. We do some interim management work, and also we've got that shareholder value specialism. So sometimes it could be we're working for 6 sessions a year, half a day, purely on strategy. It's coaching, not consulting. We do not believe in consulting. I would never, none of our strategists would ever come in and tell someone that they're running the business in the wrong way. What we would do is ask them questions that help them understand where to focus more effectively. And that's really critical. And the other reason for that is there's way too many consultants out there that will give you a report, charge you a high sum, and it will stuff itself in the drawer and you won't use it. So, we do it on a more coaching and mentoring basis than we do a consulting basis. But yeah, we're not worried if it's for sale. Clearly, I mean, we prefer that because we've got a second bite, and we like to get involved in that. But there's many that are using us without that.
Okay, so the final question. How long are buyers looking for continued owner involvement post-sale, typically?
Well, that's a good question as well. It really depends on how well prepared you are for sale. I've got a client at the moment who, you know, we're looking at. He's got a business services company, and we're talking to, you know, getting to the point of offers. And no one can believe that he spends probably a day or two a month on this business. The majority of his time is in California. Frankly, not a lot of time. On the opposite side of the equation, we have businesses where the owner is, and you know, they know this is wrong, but they nevertheless are. They are the key salesperson and driver behind the business. They are clear that they want to link a deal to performance going forward. So in that scenario, you're going to want to embrace a deal which locks somebody in for 2, 3, maybe even longer. So it's different for every deal, and it's different for every circumstance. You know, increasingly, buyers will want to make sure that somewhere there is some continuation and consulting, but it just down to circumstance.
Okay, that's it for the questions.
Great, thank you all for listening. Hope you've enjoyed it. We are running a series of masterclasses where we are going to be showcasing some more material, particularly around that shareholder value bit and how you get the strategy right to influence your multiple and push up the deal value. So we're going to be doing those on a monthly basis through 2016. So be really excited if you share us your email. We'll make sure you get in on those lists, and hope it's been useful. Thank you for listening.